Yes, hi, this is Mandar Marathe from Copper, and I am going to talk to you about how does insurance actually work, right? How does it work for you, and how does it work for the insurance company, right? Now, every individual faces risk in life, right? There are many types of financial risks which you might suffer, and because of which you might need financial compensation in case of loss, right? So you need to protect yourself from these financial loss, and that's the reason why people actually go ahead and buy an insurance policy. Let's To explain, very simply, you buy an insurance policy, you always pay a premium, right? Whether it's a monthly premium, a quarterly premium, or an annual premium, right? You decide that at the start of uh, purchasing the insurance policy, and you pay that premium regularly, right? Now this insurance policy or the insurance company protects you and your family from any financial loss in case, let's say, you die, right? So this is a life insurance policy, so in case you die, your family is being protected, right? So if you die within the policy tenure, your family receives the money as a claim to the insurance policy, right? So there are, I would say, everyone fears, that their families might have some sort of financial stress if they die, and they must buy life insurance for their family, right? So what happens actually, if you look at it from the insurance company's perspective, right? There are many people who are actually paying premiums for the insurance policies, and all these premium paid are pooled together, right, by the insurance company to create a larger fund, right? So let's say if there is a death or loss in one particular family, right? This family can be paid a compensation, right? Now, why is it possible that insurance companies make a lot of money? Because the life event of a death, right, it's not the case that everyone is going to die at the same time, right? Uh, so there might be 100 people who are paying insurance premium, but there might be only, let's say, 8 deaths for every 100 people who are paying their premium, right? So for the 92 other people who are paying their premiums on a monthly basis, right, they don't need to be compensated for any sort of loss, right? So what the insurance company will do is they will use the pooled in money to compensate the individual who is actually suffered the loss, right? Now let's take a parallel example, not related to life insurance, but an example related to, let's say, fire insurance, right? So let's say there is a village, there are 100 houses in the village, right? And each house, let's say, faces the risk of being damaged due to fire. Let's say this is a village in Australia, right? And where there are a lot of forest fires, it's highly possible that let's say a house would catch fire, right? So each and every house, what they do is, they would want to go ahead and get an insurance policy to protect themselves from fire insurance, right? And let's say the cost of rebuilding each house on an average is 10,000 rupees, right? So to secure against financial loss, these houses or the house owners will go ahead and invest in a fire insurance policy. Now let's say each house owner pays rupees 300, right? So a total from 100 houses, 30,000 rupees is collected, right? And if a house needs to be rebuilt, right, 10,000 rupees can be paid towards the costs. So at the max, the insurance company has enough money for rebuilding, paying three houses, right? Which is 10% of which is 3% of all the houses which are there in the village, right? So this is what is called as insurance premium, the 300 rupees that every house owner is paying towards protecting against a bigger loss, right? So the bigger loss is 10,000 rupees for rebuilding, and 300 rupees is the small premium that each house owner is paying, right? So insurance companies collecting this premium, pooling together the money, right? So if the let's say a fire catches a house, right? A house catches fire, right, and it's burned down. That 10,000 rupees can be provided to the house owner to rebuild the house, right? So the financial loss of that specific owner gets compensated, right? Which is an insignificant or a small portion of the total compensation or claim that the insurance company has pooled together, right? Just to summarize, insurance companies would collect insurance premiums, right? They will pool together the money, form a common fund, right, to pay the insurance claim towards an insured event. In our example, or in our case, it was the fire in the village, right? So uh, yes, that's exactly how insurance works, and I hope you understood how it works. If not, please comment below, and I will try to explain it in a much better way, right? Have a good day.